viewers, it's my Minute IAS Academy, and today we are going to see external sector. External sector is nothing but the trade which we are having with the foreign country comes under the external sector. External sector is very important for a country's growth. Why? Because it's from external sector. From foreign countries, we need resources. The resources are needed. Why? Because we might be rich in resources, but there are certain resources which may be available in their country compared to ours. So that resources may be cheap compared to ours. So we should rely on resources for the other country, and we also need a market to sell our goods. So if we have a good contact with other countries, with foreign countries, we might get a market to sell our goods in their country. So we need a market to sell our goods, and we also need technology. The technology which we need, we cannot get everything from our country itself. So we need to rely on the external sector in three things. One is resources, and second one is we need market to sell our goods, and the third one is technology. So these are the reasons why we need external sector, and the country which do not depend on external sector will be mostly underdeveloped country. Still there are certain countries which do not rely on this external sector. Example, North Korea, they are more isolated. Likewise, there are certain countries which do not depend on this external sector, but mostly the countries which do not rely on this external sector will be underdeveloped. This is the basic intro relating external sector. Then let us get into the topic. First is balance of payment. So what is this balance of payment? Balance of payment is nothing but it is a systematic record of the transactions of country with the another country. Say, it is a systematic record of all the economic transactions that India is having with other country. So that is called as balance of payment. Under balance of payment, we have two. One is current account and another one is capital account. Under current account, we have two. One is visible, another one is invisible. So you should know what is this visible. Visible or thing which is visible. Example, goods. Goods are visible, right? So it comes under the visible category, and then we have invisible. Under invisible, we have services. The services that we render are not visible, right? So services come under invisible, and the income of NRI and the donations from foreign country, and these are the things which come under invisible. Both visible as well as invisible, which means both goods and services together form this current account. Whereas in capital account, we have loan. The loan which we get from World Bank or IMF. We have already discussed about World Bank and IMF. So World Bank is the one which gives loan for developmental projects, whereas IMF gives loan during BOP crisis. During balance of payment crisis, IMF will give loan. So the loan which we have got from World Bank, IMF or from other foreign countries comes under capital account. And the investment. The foreign countries might have invested on an Indian company. There are two types of investment. One is FDI and another one is FPA. FDI is foreign direct investment and another one is FIA, foreign institutional investment. So FDI means a foreign company coming and directly investing in an Indian company is called as FDI. In this FDA, foreign company will invest in an Indian company directly. Example, we can say Hero Honda. In Hero Honda, Hero is an Indian company, whereas Honda is a foreign company. This Honda company directly invested in Indian company Hero and formed Hero Honda company. So while investing in this manner, FDI, the company will share, the foreign company will share both the profit as well as the loss, and it will create infrastructure. The foreign company will create infrastructure, and it will also bring some new technologies to India. These are the advantages of FDI, because the foreign company is directly investing in Indian company, which means it should share the profit and loss, and it also brings some new technologies and it creates some infrastructure in India. Those are the advantages of FDI. Whereas in FIA, foreign institutional investment, a foreign company will be investing in India's share. It will be buying India's shares. By buying India's share, what happens is, if there is a loss, loss in that particular company, what the foreign company will do is, it will immediately sell the share and it will run away. So this is the disadvantages of foreign institutional investment, because if there is a loss, they can easily sell the share in the market and they can go away. But in FDI, they will share both the profit and loss. Whereas in foreign institutional investment, the foreign company is not creating any infrastructure. It is not bringing any new technologies. Whereas in FDI, it is bringing new technology and is bringing new infrastructure. These are the advantages of FDI over FIA. FDI and FIA is very important for UPSC exam. And then these are the things which come under investment. And then we have banking. In banking, we have NRI deposits. NRI is nothing but non-residential Indians. NRI are also Indian citizens, but they do not reside in India and they reside in a foreign country. So the NRI deposits comes under banking. These are the things which come under capital account. First, let us start with current account. Under current account, we have already said that we have two things. One is visible and another one is invisible. Visible is goods. We have goods. So the goods which we export and the goods which we import comes under this. It is balance of payment. It contains the economic transactions which we have with other countries. So if I say economic transaction, it is nothing but the import and the export which we are having with other countries. So first one is we have export of goods as well as import of goods. We know we import more amount of crude oil because we need petrol. For petrol, we don't have much resources in our country. Because of that, we import petrol more. We know that. And likewise, we export certain things. Like we export some medicines. We are a pharmaceutical hub, right? India is a pharmaceutical hub and it exports medicines. Likewise, we are strong in something and we are weak in something. The things which we are having not enough, we will be importing, and the things which we are having plenty, we will be exporting it. So in goods, the amount of goods which we have exported is 330. And the amount of goods, 330 means 330 billion US dollars. And the amount of goods which we have imported is 510 billion US dollars. So see here, the amount of goods which we have exported is low compared to the amount of goods which we have imported, which means that import is greater than export. If import is greater than export, then it means we are in a deficit side. Because while importing, what we need to do is we need to pay dollars to that particular company. We need to pay dollars while buying the product. While exporting, they will give dollars, because while exporting, they are the one who is going to purchase our products, right? So while exporting, we will get dollars, but while importing, we are going to give our dollars. So the amount of dollars which we are going to give is more compared to the amount of dollars which we are going to get through the exporter. So because of this, we are in trade deficit in visible. Then we have invisible. In invisible, 208 is the amount of services. In invisible, we have services and we also have remittances. Remittances is nothing but the salary which NRA is getting. So the amount of services, in services we have tourism, IT and doctors, some Indian persons who reside in foreign country and they will render some service to that foreign country, right? Everything comes under this invisible. And under this 208 is the amount which we have exported, 208 billion US dollars, and 126 is the amount which we have imported. Considering invisible, the amount of goods which we have exported is 208, which is greater than the amount of services which we have imported. So here in invisible, the amount of goods which we have exported is greater than the amount of services which we have exported is greater than the amount of goods which we have imported. So this is the case. In case of services, so the export of services greater than the import of services. So we are in surplus. In invisible, we are surplus, whereas in visible, we are deficit. And in invisible, we also have another one thing called as remittance. Remittances is nothing but the salary which NRA is getting. In remittances also, India is surplus, which means the NRA person's salary, the remittance which NRA, Indian persons getting in a foreign country is high compared to that of import of the services. Say import of services, a foreign person residing in India and he will be giving some services to India, right? And that is low compared to the NRA salary. So considering remittance, India is surplus. Considering invisible totally, India is surplus. But in visible, which means in goods, India is deficit. So this is the first thing. We should calculate one thing called as balance of trade. So balance of trade is nothing but it is the difference between the export as well as import. Gives the balance of trade. We have balance of trade. Balance of trade is nothing but it is the difference between import and the export. While talking exports, we should add both goods export as well as the service export. The amount of goods which we have exported is 330 and the amount of services which we have exported is 208. So the total amount of thing which we have exported is 538 billion US dollars And let us talk about imports. In import also we have both goods as well as services, which means the visible category as well as invisible category is added. That's it. So in import we have 510 in goods, and in services we have 126. By summing up this we will get 636. So see, the amount of goods and services which we have exported is low compared to the amount of goods and services which we have imported. So it is simply E is lesser than I, which means the export is less compared to that of import. So import is higher. If the import is higher, we need to give more dollars from us, and the amount of dollars which we are getting from the foreign country because of the export is low. That is the basic thing. So if it is the case, then we are in trade deficit. If export is less compared to that of import, then we are in trade deficit. If the import is less compared to that of export, then we are in trade surplus. But India, in balance of trade, the current position is it is in deficit. It is in deficit in visible. It is deficit in the totally India is deficit in trade. Whereas in invisible, whereas in services India is surplus, and in remittances also India is surplus. These are the things which are relating to foreign trade. And then we have certain goods which we import more, and the certain goods which we export more, and we also have certain countries from where we export more. Let us see those steps after this pandemic, the things after pandemic. Let us discuss the current exports and imports. So first, the top components, the top imports of India is first is crude oil. Crude oil is the top one which we import more. We are talking about import. And the second one is petroleum products. First crude oil, crude and petrol products, and second one is we have petroleum products. Third one is we have gold. The amount of gold we import is also more because there is no high gold reserves in India. So we import gold more. And the fourth is telecom products, and the fifth one is coal. These are the things which we import more. The first relating imports, the top one which we import more is crude oil. Then second one is petroleum product. Third gold. Fourth telecom instruments. Fifth one is coal. These are the things which we import more. And in exports, the thing which we export more, the top one is petroleum products. You can ask why here we import more and why here we export it more. Actually what we do is we do some value addition. We bring some changes. We import the petroleum products and we give some value addition to it and we export it to other countries. So first one is petroleum products, second one is pharmaceuticals. During this pandemic also you would have seen that we exported many of our medicines to foreign countries. The drugs, we have pharmaceutical products which we export more. So it ranks second in exports. And the third one is we have precious stones. India have more precious stones and we export it more. And the fourth one is iron and steel. And the fifth one is electric machinery. These are the things which we export more. The things we import more are crude oil, petrol, gold, telecom instruments and coal. Whereas the thing which we export more are petroleum products, pharmaceutical things. Then third one is precious stone, fourth iron and steel, and fifth one is electric machinery. These are the top imports and top exports of India. And then we have top countries which contribute to the exports and the top countries which contribute to the imports in case of India. In case of India, the top import source is China. China is the top import source because from China we import many electronic goods. So it is the top import source. And the second one is USA, third UAE. So let us remember three things. First one is China is the top import source of India, followed by USA and UAE. And the top export source of India is, the top export destination of India is, first one is we have USA, followed by UAE and China. USA, UAE and China is the top export source. And after this, let us see the countries which with which India is having trade surplus and trade deficit. First, let us discuss trade deficit. Trade deficit means the amount of goods which we export is low compared to the amount of goods which we import from that particular country. So, talking about deficit, the first country is China. We have trade deficit with China because the amount of electronic goods which we import from China is more compared to the amount of goods which we export from India. Second, we have Switzerland. With Switzerland also, India is having trade deficit. Why? Because it's from Switzerland we are getting so many luxury goods. So because of this, we are having trade deficit with China as well as Switzerland. And the other countries with which India is having trade surpluses, we have two. One is USA. With USA we have trade surplus. Reason is to USA we export many textile products, we export services to USA, and we also export some chemical products to USA. Because of this, with USA India is trade surplus, and with UAE India is trade surplus. With USA and UAE India is trade surplus, whereas with China and Switzerland India is trade deficit. And other than these things, the countries which contribute highest to the export, the countries which contribute highest to the imports in the world. Talking about the world scenario, the largest exporter of goods. The largest exporter of goods in the world. We are talking about world. The largest exporter of goods in the world is, first one is we have China, and India is in 19th position. Relating goods. Whereas the largest exporter of services in the world is USA. USA is the largest exporter of services, and India is in 8th position. It is okay, but comparing with the goods, see, relating goods exports we are in 19th position, but in services export we are in 8th position. So the largest exporter of goods is China, and the largest importer of goods is the largest exporter of goods is China, and the largest exporter of services is USA. And then we have import. The largest importer of goods is USA, and the largest importer of services also USA. In import, the largest importer of goods is USA, and the largest importer of service is also USA. In import, both the largest importer of goods as well as services is USA. While talking about import of goods and services, India is in 10th position. While talking about import of the services, India is in 10th position. So, in both these things, India is in 10th position while talking about import of goods as well as services. These are the things which are relating to the external trade. Then we have certain schemes and things which are relating to the external sector. Let us see those things. First is production linked incentive scheme. Production linked incentive scheme is nothing but you are producing 100 products today, and if you have increased the production and if you are producing 120 products, and for this 20 products you will get a incentive. That is production linked incentive scheme. Why? Because if the production is increased, then automatically your export will increase. If the export is increased, then you will be strengthening your external sector, right? You will be balancing your trade and you will be becoming trade surplus. So, for increasing the production, they give incentive, and that is called as production linked incentive scheme. So, if you are producing 100 today and if you have increased the production to 120, for this 120 products, you will get an incentive. Why? Because if the production is increased, then the export of the product will also increase. This is the thing which is behind the production linked incentive scheme. This scheme is introduced recently, and it also helped the pharmaceutical sector so much. And then we have global migration report. The global migration report says that India is the #1 country based on the number of people migrated. Based on the number of people migrated to the foreign country, India is #1, followed by Mexico. Mexico is #2, and third one is we have China. Based on the number of people migrated, India is #1, and based on the remittances the country is getting. Remittances is nothing but salary of the particular person, salary of the NRI. Based on the remittances also, India is #1, followed by China, then Mexico. So, based on the remittances as well as based on the people, India is #1 in global migration report. That is the important thing you should remember. And USA is the topmost destination. The people who migrate mostly prefer USA. So, USA is the #1 preference. So, #1 USA based on the more people migration to USA. And these are the things which are given in global migration report, and you should know the World NRI Day. World NRI Day is celebrated in Jan 9. Why? Because it is the day when Mahatma Gandhi came to India. So Jan 9 is called as World NRI Day. Then let us go to import of oil. So we have already seen the top imports as well as the top exports of India. The top import of India is oil. Crude oil is the top import of India. So we should reduce the crude oil. Why? Because it's the 85% of the crude oil which we need is imported, whereas only 15% of the crude oil which we need is produced in India. out of the crude oil need which we have in India, 85% is imported and only 15% of the crude oil which is needed in India is produced by India. So we should increase our production. While increasing the production, what happens is the import of the product will be reduced, and if we produce more and more, then we can export it also. So we should increase the production to reduce the imports. So to increase the production of the crude oil, government has introduced some schemes to increase the production of crude oil. And let us see those schemes. First one is we have India's domestic oil exploration policy. India's domestic oil exploration policy. This policy is under the Ministry of Petroleum and Natural Gas, and the main objective of this India's domestic oil exploration policy is to increase the production of crude oil and to reduce the import of crude oil. This is its main objective. And ONGC, you know ONGC, right? ONGC is the one which is mainly involved in exploring this oil and gas in India. So there is a scheme, another one scheme for this import of oil. We have NELP. NELP is nothing but New Exploration License Policy. It gives license for the exploration of a particular product. Say exploration of a shale gas or exploration of petrol. They give license for a particular product. That is called as New Exploration License Policy. So it gives separate license for exploring a particular product. But this NELP is replaced by another one thing called as HELP. HELP is the one which replaced NELP. HELP stands for Hydrogen Exploration and License Policy. The difference between NELP and HELP is HELP gives a uniform license to exploration of all the hydrocarbons. For the exploration of all hydrocarbon, it gives a uniform license. It gives a single license. That is HELP. So if I talk hydrocarbon, then methane, shale gas, petrol, everything comes under it. So that is the advantages of HELP. And also the other advantage of HELP is it has revenue sharing policy, which means that you don't need to pay any tax to the government, but instead you need to give a portion of your revenue to the government. There is a revenue sharing policy under this HELP. These are the advantages of HELP over NELP. These things are done. This India's domestic oil exploration policy under the Ministry of Petroleum and Natural Gas, this NELP, HELP, all this is done to reduce the import of crude oil and to increase the production of crude oil to become self-reliant in this oil sector. These things are done by the government. And then we have import of gold. So relating import of gold, we have already seen the import of gold is high. I think it is in the third position. So we import gold more. Why? Because we are attracted towards gold. Indian people are so much attracted towards gold. They buy gold jewelries and all that. So we should reduce the gold. Why? Because this gold is not considered as an investment by many economists. So many economists don't consider gold as an investment. Why? Because it just blocks the money. It is going to block the money as a jewel or anything. So what government done is they have introduced a scheme called as sovereign gold bond scheme. Sovereign gold bond scheme is introduced and they give bonds. They issue bonds. This is introduced by RBI. RBI will issue bonds in the denominations of 1 gram and its multiples. So in the denomination of 1 gram and its multiples, RBI will issue bond to the people. You can buy the bond and there will not be any gold. So in the denomination, if you are interested to buy gold, then instead of this gold, you can buy the gold as a bond. So 1 gram gold, say if the 1 gram gold is 4,000 rupees, then this 1 gram gold bond will be 4,000 worth and you can sell this bond after a certain period of time. So if you are selling it after 5 years, then you can sell it for the current price. The current price after 5 years may be 10,000, so you can sell it for 10,000. If you are planning to invest in gold, then you can invest in this bond. So this is what planned by the RBI. Then we have SEZ. SEZ is nothing but Special Economic Zone. So Special Economic Zone, you should know Special Economic Zone. It is important, it is in news. So it is nothing but it is a zone for promoting the exports and it is treated like a foreign area. It is in India. Actually, the Special Economic Zone is in India, but it is treated like a foreign area. Why? Because it's inside SEZ, there are so many benefits that a company can get. There are many trade tax benefits and there is many tax exemptions and they get 5-year tax free, and also they get free electricity, free water, and they get road facilities, and the facilities which are given by the government will be extraordinary. They get so many benefits if they are under this SEZ, Special Economic Zone. It is inside the Indian territory, but it is treated like a foreign area. They are exempted from many rules and regulations. They are exempted from they give many tax benefits and tax exemptions. They are given 5-year tax free, and they are given free electricity, free water. They are given free road facilities, and all those will be given under this SEZ. These things are done to promote the exports. These things are done to promote the exports. Why? Because if they are given so many free things, because of this the cost of the product will be reduced. If the cost of the product is reduced, the export price will also be reduced. If the price of the product in export is low, then automatically many country will be interested to buy the particular product, right? So because of this, the government gives so many subsidies and incentives to the exporters. So that is Special Economic Zone. And then we have Interest Equalization Scheme. So like SEZ, we have another one called as MEIS and SEIS. Special Economic Zone is only for goods, whereas this MEIS and SEIS is for goods as well as the services. So MEIS stands for Merchandise Export from India Scheme, whereas SEIS stands for Service Export from India Scheme. It is for goods and it is for services. So in SEZ they cover only goods, whereas in MEIS and SEIS they cover both goods as well as the services. So under this scheme you need to pay the tax. Here in SEZ you are given tax exemption, you are given some benefits, you are given free electricity, free water, everything free. But here you need to pay the tax, you need to pay the transportation charges, you need to pay the mandi tax, you need to pay everything. But what government do is, the government will credit it. You need to pay, but the government will credit it after you are paying. You say if you have paid 1000 rupees, you can collect it from the government. So government will credit it back to you. So that is the difference between MEIS and MEIS, SEIS and SES. In SES you are exempted from the tax. You are given free electricity, free things. Whereas in MEIS and SEIS you need to pay for everything, but the government will credit it back to you. This scheme is for the tax credit. This scheme gives tax credit to the exporters. And then we have Interest Equalization Scheme. Interest Equalization Scheme is nothing but say if you have got 1000 rupees from a bank and you need to pay 10 rupees as interest. You have got this 1000 rupees for investing in export. You are doing export related company. You have export related manufacturing company. Then this 10 rupees which you need to pay as an interest will be paid by the government of India. Why is? To promote your exports. If this 10 rupees is paid by the government of India, then you will be motivated. Because of this, you will produce more and you will be strong in your export, right? Because of this, our government is the one which is going to get benefited. It can become trade surplus. So your interest will be paid by the government of India if you are involved in exporting. Then this scheme is called as Interest Equalization Scheme. Your interest paid by the government of India to boost you if you are in export sector. That is Interest Equalization Scheme. Then we have Export Preparedness Index. This Export Preparedness Index is by Niti Aayog. Niti Aayog is the one which releases this Export Preparedness Index, and it ranks the state based on the preparedness of the exports, based on how well the infrastructure is relating to the particular state for exports, how well the connectivity, say connectivity means we have road connectivity, sea connectivity, port connectivity, rating export. They see the connectivity, infrastructure and the ease of doing business. They check all these things and they rank the states. So this is done by Niti Aayog. Based on the Export Preparedness Index, the first state is Gujarat. Gujarat is number 1 based on the Export Preparedness Index, and the second one is Maharashtra, third one is Tamil Nadu. So based on Export Preparedness Index, the state which is ranked 1 is Gujarat, second Maharashtra, third Tamil Nadu. This Export Preparedness Index is released by Niti Aayog. These are the things which are relating to external sector. Subscribe to Myla IAS Academy. Thank you.